Yesterday, December gold futures traded above 4,000 for the first time ever. In fact, I think they closed above 4,000. And that became a pretty big news story, at least in the financial media. I listened to quite a bit of coverage of $4,000 gold, although technically gold was not at 4,000 yesterday because the December futures contract is the price to pay for gold that's not going to be delivered until December. The spot price is what I pay attention to for records. And yesterday, spot gold never quite made it to 4,000. I think it came maybe $10 away at its peak, but it didn't get to 4,000. Well, that changed today because spot gold blew through 4,000. In fact, the intraday high, I believe, was 4,050 something. So we got more than $50 above 4,000. I think, gold was up better than $70 on the day at its high, although it closed off its high, maybe up about $50, $55. And as I'm recording this podcast live on Wednesday evening, gold's down another $23 in early Asian trading. So it's trading back below 4,020, but it's still holding above 4,000. Now, look, obviously, gold could go back below 4,000. I mean, that's not some kind of line that can't be crossed. And it's hard to say whether or not we're going to have a pullback from here. I mean, certainly the market is due for a pullback. I mean, we've come a long way. In fact, year to date, the price of gold is up 54%. I mean, that is a huge move. First of all, the year's not even over yet. We still have most of the fourth quarter left. But the last time gold was up this much in a calendar year was the 1970s. Now, that was a very significant time period. And by the way, silver rose today by an even greater percentage. It actually traded above $49.50 at the high. As of this morning, or right now, it's back below $49. I think it's trading around $48.80. But the intraday high, it got above $48.50. I mean, $49.50. So very, very close to $50, which is that key level for silver. But if you have to go back to the 1970s to find a year where gold was this good, and of course, it's not like gold had a bad year last year. Gold had a great year last year. It's just having an even better year this year. And of course, a 54% move from where gold was, dollar-wise, is a much bigger move. Think about the value of that move, because you're talking about a metal that's already, mid-2000s and moving up to 4,000. That's a big dollar value of the rise in what all the gold is worth. But if you've got to go back to the 1970s to find something like this, that probably means that what is happening now is likely as significant as what happened then. Now, what happened in the 1970s? You got to understand this, because it was 1971 that Nixon took us off the gold standard. It was supposed to be a temporary move, but it's now been better than 50 years, and we didn't go back on it. But that was a very significant development, because up until 1971, if central banks in Europe or anywhere held U.S. dollars in reserve, which they did, they knew that whenever they wanted to, they could take those U.S. dollars back to the U.S. government and exchange them for gold. It was a fixed rate. If you had $35, you had an ounce of gold. The Federal Reserve note was basically a receipt that paid the holder of that receipt an ounce of gold. You had $35, you could turn them in, and you could get an ounce of gold. Now, in the meantime, you could take those $35 and buy U.S. Treasuries and earn interest, which is something you couldn't do on your gold. But by allowing the Federal Reserve or the U.S. government to hold your gold, which is basically what the world was doing, right? We were the custodian of the gold, right? So Germany or Italy or France or the UK, they hired the U.S. government to hold custody of their gold. And we issued them a warehouse receipt in the form of U.S. currency that represented, a pay to the bearer on demand. Now, of course, at one time, everybody, right? You didn't have to be foreign to convert your paper into gold, right? The initial Federal Reserve notes before 1933, right, were redeemable in gold by everybody. So an American citizen that had $20, because back then the official price of gold was $20. So if you had a Federal Reserve note for $20, you could take it to the Federal Reserve and they'd give you a $20 gold piece, right? It was an even exchange. So that piece of paper represented an IOU for gold. In fact, that's what gave the paper the value. It was the gold that backed it up. Now, 1933, after Roosevelt, told everybody that to turn in their gold and made it illegal for Americans to own gold, Americans couldn't convert their notes into gold. But foreigners could. Right? It was only American citizens that couldn't get the gold. But if you were a foreign holder, you could still get gold. Now, Roosevelt devalued, so now you needed $35 to get an ounce of gold, not $20. But if you were outside the United States, if you were a foreign central bank and you held U.S. dollars, you were still able to redeem them. In fact, the pieces of paper weren't dollars. The gold was the dollar. The dollar was defined as a weight of gold. The Federal Reserve note, which was the piece of paper, is an IOU for dollars. The dollars were gold. Now, they were also silver. And in fact, while it was illegal for Americans to own gold, it wasn't illegal to own silver. And so they had silver certificates. The Federal Reserve issued currency backed by silver, and you were able to get silver up until, we took the silver away in 1963, 1964, and then we took all the silver out of our coins. But you were able to get silver because, you could take a dollar bill and get 4 quarters. And those 4 quarters were silver, right? So you were able to exchange your paper dollars for silver just by going to a bank and getting change, right? And you can get real money. You can get real dollars. You could get silver dollars, right? The Federal Reserve note was an IOU. In fact, if you read what it says on the Federal Reserve note, it doesn't say it's $1 or $5 or $10. It says pay to the bearer on demand, $10. The $10 is a weight of gold or silver. And so it's an IOU. So, but up until 1971, these foreign central banks who were holding U.S. dollars were really holding gold. They were just storing it in the U.S., in Fort Knox. They were storing their gold. And we gave them this IOU. But what they were able to do with that IOU was purchase U.S. Treasuries. So now they can earn interest on their gold because their goal was, they still owned the gold. They could get it whenever they wanted. But in the meantime, they were able to earn interest. Now, when we went off the gold standard, that was a major disruption of the world monetary order. And it led to a major devaluation of the U.S. dollar, not only relative to other currencies like the Deutschmark or the Swiss franc or the Japanese yen or the pound sterling, but against gold. Because prior to 1971, if you held dollars, you held a currency backed by gold. After 1971, if you held dollars, you had a currency backed by nothing. Now, clearly, a currency backed by nothing is not as valuable as a currency backed by something, especially when that something is gold. So the world marked down the dollar because we changed the rules. We told everybody that you're not going to get your gold. We basically defaulted. When they talk about how, the U.S. government has never defaulted, when they talk about the debt ceiling, we've never defaulted on our treasuries. We defaulted on Federal Reserve notes. The reason that a Federal Reserve note is called a note is because it is a promise to pay, right? What does the Federal Reserve promise to pay? If you own one of their notes, what are they promising to pay you? Well, initially, they promised to pay you gold, right? They promised to pay you real money, lawful dollars. That's what the promise was. But now the Federal Reserve notes are notes for nothing. It's an IOU nothing. It just says this note. It doesn't say what it's redeemable in. So we defaulted on those notes. The world held our notes because we promised to pay gold. And then we told the world, we're paying nothing. I mean, we didn't even say, we'll give you, 50 cents on the dollar, 25 cents on the dollar. We told the world, we're giving you nothing, right? We're not giving you any gold for these notes. It was 100% default. Now, of course, we said, you're free to hold on to those dollars. They're just not backed by gold anymore, right? And so the world held those dollars, but at a much lower rate. And that's why prices went up so much. I mean, the reason that oil went from $3 a barrel to like $35 a barrel, right? More than a tenfold increase. And, we like to blame that on the Arabs, right? Oh, those Arabs, they jacked up oil prices. We had this oil shock. It wasn't the Arabs. It was us. It was America. We tried to screw OPEC over because when oil was $3 a barrel, we paid them $3 backed by gold. So they were getting gold for their oil. Well, after we defaulted, we were paying paper. And so OPEC said, well, if you're going to pay us paper, well, we're not going to sell you oil for $3 anymore when we can't get any gold. And so the price went up because we paid them in paper instead of gold. If you look at what happened to oil prices in terms of gold, the real price of oil went down. It's just that because we tried to screw OPEC over by giving them pieces of paper instead of real money. And they said, okay, if you're going to give us paper, we'll take it, but we need $30, not $3, right, to make up for it. And that's what happened, right? All these prices went up. But gold had these big moves because the dollar was being devalued, because we, America, we went off the gold standard. Now, the world continued with the dollar standard, meaning that the U.S. dollar continued to be the primary reserve currency around the world and the main currency used in international trade, despite the fact that it was no longer backed by gold. So the world didn't go off the dollar standard, but it devalued the dollar because it was no longer as good as gold. It was something less. And that was a major shock, right? That's why we had the stagflation of the 1970s. We had a major resetting of the cost of living. The result of that, women in the 1980s and 90s who never had to work had to go into the workforce because their husbands could no longer support them because they were no longer earning dollars that were backed by gold. Their salaries were now just paper, and it lost a lot of value, and so the cost of living went up, and so one paycheck could no longer support the family, and so you had a second breadwinner that came into the labor force so they could pay the rent and put food on the table and keep the lights going. But it was a big decline in our standard of living as a result of what we did. But what's happening now, I think, is an indication that something just as significant, and maybe even more so, is happening. That is what gold being up 54% so far and smashing through $4,000 an ounce. That is what gold is saying. The problem is most people aren't listening to what gold is saying. And it's very similar to warnings in the past that went unheeded by people who never understood the problem.